Hello traders, this is Cliff Wachtel, Chief Analyst for AnyOption.com. I'm here to talk about the euro and the likely market drivers behind it for the coming days and the likely trends that we're going to see. The key point of this video is going to be that this nascent beginning trend in the euro is likely to keep right on going, right through March. Why? Because just like a year ago, the EU leaders will not be able to agree on paying up money to expand the bailout fund that is necessary to prevent defaults among the PIGS nations until we get to the point of a crisis, until we've got at least one nation, be it Ireland, Portugal, or Greece, that is on the verge of default. And that, of course, means that once we get one default, we get a wave of defaults among these nations because none of them will be able to sell bonds anymore. And that means we get a domino effect wave of defaults among the European banks that hold these bonds, and then a European banking crisis. That, of course, sparks fears of a global banking crisis. Just like last year, no surprise, back in 2008, the crash of just one bank, Lehman Brothers, was enough to crash the markets worldwide. Imagine the effects of an entire European continental banking collapse. And when that happens, everyone's going to get together and get an expanded bailout to buy time. But until then, the euro is heading lower. Once we get that crisis, then throughout the world, in Berlin, the German leaders will be able to tell their voters, what could we do? Without the bailout, alles is kaputt. In Paris, mon ami, if we do not give them the money, c'est tout, fini. Even in Washington, where the IMF, the International Monetary Fund, lives and is mostly funded, even the Republican Congress will have to say, friends, by giving them this money, we were saving our own necks. From those market drivers, particularly going to be focused on the euro dollar, but what I say also applies to the euro yen and the euro franc, its other chief trading components. So let's get started. Now, over the past number of weeks, the euro's had a nice uptrend, and that's been powered by two primary fundamental drivers. And the first was, of course, rising risk appetite, general market optimism that we saw in the S&P 500 or other major stock indexes. And the other, and that this was particularly potent in recent weeks, were rising expectations that the European Central Bank would in fact be increasing interest rates sooner than expected. A number of central bank members talked about it, said they needed to do it. The market correctly interpreted this as a hint. And then finally, on Thursday, March 3rd, the ECB press conference, Jean-Claude Trichet used the key word vigilance. He said we have to be vigilant about rising inflation. Again, central banks just don't come out and say what they do. They speak in code words. In the case of Trichet, he said, we need to be vigilant against the inflation. We must be en garde. Ha! That was his emphasis, as opposed to being more worried about growth, which would have been interpreted as dovish. So in fact, this rather hawkish press conference and comments gave the euro a very nice boost, follow through, continued up a little further, and then it ran into, as expected, what's been very strong resistance for the euro dollar over the past year, this 1.400 zone. And that left the euro looking for another fundamental driver to push it farther. Now, again, the only one we've really had for the euro has been rising risk appetite, particularly for the euro dollar, the euro yen, and the euro franc, because the euro is a riskier currency. Those others are safer, more safe haven currencies. So the euro dollar, the euro yen, and the euro franc tend to rise when there's more risk appetite. And with interest rates now pretty much priced in, we needed more rising risk appetite. However, that hasn't been happening. Why? Let's take a look at that. So why has risk appetite stalled out? I mean, here we are. Let's take a nice look at the S&P 500 index, our favorite picture of overall risk appetite. We see it was in a multi 6-month uptrend. All of a sudden, boom, hits a wall and has been has come down, basically consolidated ever since with some support around 1300. What happened here? Well, for anyone who's been following the markets at all, the answer is well known. In a word, oil. More specifically, Mideast, North Africa unrest, and the uncertainty it's created about oil supplies, which of course has resulted in a massive spike in the price of oil. Looking from the time the crisis really hit the markets and caught market notice, which was when it hit Egypt, and because Egypt controls the Suez Canal, we've seen oil rise from about $85 up to peaking basically still around $105. Now keep in mind, that's a $20 barrel increase, and it's widely believed that for every $10 increase in the price of a barrel of oil, gross domestic product, GDP, for any country that is an oil importer, and that's almost everybody, GDP drops 0.2%. So think about this. We've had, over the past just few weeks, a potential 0.5% drag on growth, and with a lot of countries looking at stagnant or negative growth, and we've just shoved them down another 0.5% point. This is very, very serious, and consequently, it's no surprise that risk appetite, as we see in the S&P 500, has hit a wall in the past few weeks. Very, very serious situation, and so we have to ask ourselves, with the two, looking at the two primary drivers of risk appetite for the of the euro. One, interest rates, that's been basically priced in, and the other, risk appetite, stalled out. So what's the next likely big driver for the euro? Well, the near-term answer seems to be the belief that this Friday's EU summit will fail to produce any real progress in solving the EU sovereign debt and banking crisis. Now that raises fears of, ta-da, a second annual EU spring breakdown. Now, if you remember last spring, we had a similar situation. Greece was in need of a bailout. The EU officials just kept bickering. There was no solution. Meanwhile, Greece was getting closer to a default, and that sent the borrowing costs of all the other pigs nations going higher, because everyone understood that once one country defaults, none of the weak countries will be able to sell any bonds. They'll all default, and the institutions holding the bonds, which are of course no one other than the major EU banks themselves, will now be destabilized. There will be all kinds of questions about who is still solvent and who is not. And of course, just the mere uncertainty of who's exposed to who and who may be solvent and who may not be is enough to stop interbank lending in the EU. That's enough to crash global economies, because who knows who's really exposed to the EU and the EU banks. And we get a global crash similar to what we got in 2008, which, again, the catalyst was just one big bank, Lehman Brothers. Never mind the fear raised of an entire continental banking system crashing. And so everything sold off. Now, why do we have this sudden rise of concern about the EU banking crisis? It comes and goes. What started it up the anxiety again? Firstly, of course, markets are no longer focused on rising euro rates. We've already had the rate hike news. Secondly, we've got rising pigs bond rates again. 10-year bonds for Portugal and Greece are about record highs. That usually precedes another bout of EU crisis. Also, we've got a newly elected Irish government that got elected on the promise, its commitment to get a better bailout deal. They went before their electorate, before their Irish voters, and they said, you can bet your last bottle of Jameson, we're going to get a better deal for you on the bailout. And that's why they got elected. So there's tremendous pressure on this government to show their voters some results. If not, they'll quickly wind up out of office and replaced by somebody more militant. The EU understands this, but that raises the question, of course, of who's going to take the loss, because the European banks holding Irish bonds, and therefore other pigs bonds that will also be have questions raised about them, will now be taking loss. If Ireland's going to get a better deal, well, we've got to give a better deal to Greece. We've got to give a better deal to Portugal. They're expected to come knocking for a bailout just about any time. So that raises the question of who's going to ultimately take the loss on the debt from giving these pigs nations a better deal. Who? Well, the current plan has been for an expanded bailout package, just like what we had last year, but we've got more countries in trouble, and so a bigger fund to bail them out, a bigger fund to give countries that can't pay their current debt more debt. But it does buy some time. This is how politicians think. Kick the can down the road, extend and pretend, you know the deal. Now, however, even that, the prospects for that expanded bailout fund are far from clear, and this is what's scaring the markets. That bailout money may not be there when the next default crisis comes, and we may get another crash. Why is this? First off, German officials cannot be generous right now because they've got an election coming up, and their voters are in no mood to start making more gifts to their fellow Europeans. By the way, we had the exact same problem last year. In German, every time there was a bailout fund or a plan, German officials were opposed. And as the biggest economy, they're expected to make the biggest contribution, and so their support is critical. Now, everyone knew a crisis was coming. The Germans weren't stupid by any means. They simply understood that these officials understood before they could go to their voters, they had to be able to have a crisis with global market crashing, and then they could turn to them and say, "What could I do? Without the bailout, alles is kaputt. We don't sell the Mercedes, we don't sell the Bosch coffee maker," and so on and so on. And that's what markets are very worried about is going to happen now, that we won't be able to get that kind of cooperation until there's a crisis, and the big funding countries like Germany will have the political cover of a crisis to to expand that bailout fund, and again, just buy some time for be it Ireland, Portugal, Greece, whoever else it may be. This is the big scare. And by the way, it's not even just Germany anymore. France is the second largest economy, and therefore also would be a critical component to any expanded bailout fund. In a recent poll, President Sarkozy finished third. So he too may well be having considerations, sitting back in his office thinking, more bailout. I don't know. Pierre, it doesn't sound good. What do you think? That may be the problem. And this is what's got markets really worried for the coming days. And so the trend looks like it's going to be down for the euro because it looks like we're going to get more anxiety about what's going on in the EU. Practically speaking, that means downtrend for the euro dollar, the euro yen certainly, possibly the euro franc, even though that's sort of been an overdone story. And that's what's likely to be. Forex traders trade with who have access to trading these currencies directly, can be using their leveraged spot accounts. Binary options traders on the euro dollar, on the euro yen, on the euro Swiss franc possibly. Your better probability bet on your hourly, certainly on your hourly and daily binary option expiries will be with put options on the euro dollar, the euro yen, and the Swiss franc. This is Cliff Wachtel, Chief Analyst, anyoption.com. Good luck.